Hi everyone, welcome to our 12-part series, Inside the One Big Beautiful Bill Act. I'm Kenny Birch, a tax director in our mortgage banking tax practice. And throughout this series, we're breaking down the most important tax changes under OB3 and what they mean for you. These updates can have a real impact on planning, compliance, and your bottom line. So if you want to stay ahead and make informed decisions, you're in the right place. Let's take a look at the mortgage interest deduction, what OB3 changed, and what taxpayers should keep in mind with Jenny Trask, an expert in our mortgage banking tax practice.
Hi Kenny, thanks for having me.
Of course. Jenny, I think we start really simple. What is the mortgage interest deduction in the first place?
It's a tax deduction individuals can take for mortgage interest paid to a qualifying party. Essentially, it reduces taxable income, but there have always been limits on how much can be deducted each year.
All right. Can you tell us what the rules were before OB3 was enacted?
Previously, under the Tax Cut and Jobs Act, which was enacted in 2018, individuals were limited to a mortgage interest deduction only on loans of up to $750,000 of acquisition indebtedness. But that was set to expire at the end of 2025, and the acquisition indebtedness limit would have returned to the pre-TCJA limit of $1 million.
Got it. And then how did OB3's enactment change these rules?
OB3 made the $750,000 acquisition indebtedness limit permanent, including mortgage insurance premiums.
Great. So basically, mortgage interest and mortgage insurance premium deductions are limited to only the amounts applicable to the first $750,000 of acquisition indebtedness. Is that correct?
Yes, any mortgage interest and mortgage insurance premiums applicable to the acquisition indebtedness over $750,000 are not deductible.
Okay. Can you speak a little bit about how the Form 1098 might change?
Sure. There will be no change to the Form 1098 reporting for the 2025 tax year from how it was reported in 2024. However, the IRS recently released a draft of the 2026 Form 1098, which is very similar to prior versions. Mortgage interest will be in Box 1, and mortgage insurance premiums will be in Box 5 of the 2026 Form 1098. Also starting in 2026, Forms 1098 will need to be filed through the IRS system, which is the Information Returns Intake System, rather than the FIRE system, which is currently used.
Thanks, Jenny. Do you think you could give us an example of how the limitation works?
Of course. Let's say an individual has $1 million of acquisition indebtedness, and in 2025 they paid $20,000 in mortgage interest and $4,000 in mortgage insurance premiums. In that case, they would only be able to deduct 75% of the $20,000, which is $15,000 of mortgage interest, and 75% of the $4,000 of mortgage insurance premiums, or $3,000.
Okay. And if there is a limitation, can they carry that over to future years?
That's a great question. Unfortunately, no. The amounts above the limit are not deductible in the current year or in the future. So to sum it all up, the deductions are limited to the amounts applicable to loans up to $750,000, and the amounts above that are never deductible.
That was a great summary, Jenny, and thank you so much for clarifying the mortgage interest deduction changes. If you want to stay ahead on other tax updates, please check out the rest of our OB3 series.